Welcome back, everybody, to Passive Income Lifestyle Series. I'm Travis Watts. In this series, we're talking about passive income and real estate and how to elevate and enhance your lifestyle through investments. In today's episode, what we're talking about is how to get double-digit pay increases every year. I'm going to show you how to do that. Keep in mind, informational and educational purposes only, never financial advice. I'm not a financial advisor, not telling you or anyone else what to do. So with that top of mind, let's go ahead and dive in. Before shooting this episode, I was just on SSA.gov, which is the Social Security Administration website, and I found out that in 2022, the average American wage was nearing about $60,000 per year. Also on this website, I found out you can look a little bit deeper into average wage increases year over year, going all the way back to 1984 through 2022. And collectively, I'm just shooting a ballpark out there. It's been about a 4% annualized pay increase. And the reason I'm sharing this with you is just to paint the foundation for what we're going to talk about in this episode. We don't have to actually use any factual information to paint this concept, but I'm just trying to break it down to what's happening in reality. So the two takeaways so far is we're going to use a person who's making $60,000 gross income per year living in America, and they're getting a 4% annualized pay increase throughout their working career. So using a salary increase calculator that I found online, there's many versions of them for free, or you can pull out your handy dandy calculator. I wanted to figure out how long it would take somebody to effectively double their salary if they were always getting a 4% pay increase every year. Turns out it's 18 years, and you can figure that out by using what's called the rule of 72, which is simply you take 72 divided by the annual percentage increase of either an investment that you have, or in this case, a pay raise, and we put in 4, and that gives you 18. So it's 18 years. So with all that top of mind, let's go ahead and dive into how you can effectively get double-digit pay increases year over year. So let's say that a person making $60K per year decides to make one investment in their lifetime, only one, never investing again, and they decide to make a passive income investment, whether it be real estate or whether it be, dividends or interest or what have you. And this passive income gets paid out on a monthly basis. And for example purposes, we'll say that the annualized yield is 8%. So in this example, what really just happened is this particular person begins generating roughly $400 extra per month, or $4,800 per year. And what that amounts to is about an 8% annualized pay raise. And the great thing is they're not having to rely on an employer for a pay raise. If there happens to be a recession or a tough year or some layoffs or something, and there's a few years that they don't get a pay increase, at least hopefully they would get this out of their investment to help supplement that. But if they did get the 4% from their employer, then what happens? They effectively generated a double-digit pay increase year over year because they got 4% from an employer and 8% from their investment equals 12% total. But it gets even better. If this particular investor decides, I'm not going to spend or use that cash flow or those dividends, I'm just simply going to reinvest them. What that means is that in year 2, they now have $64,800. And if you break that down at 8% a year, it's about $432 per month, or a little over $5,000 for the year. So that amounts to about an 8.6% pay increase in year number 2, based on the $60,000 salary. Again, not factoring in any employer pay raises that he or she might have had. So one simple takeaway so far is if you become a passive income investor, then you're effectively more than doubling the results of the average American, but it actually gets better than just that. You see, active income is taxed at the highest tax brackets. At the federal level, that maxes out around 37%, plus any applicable state income tax depending on where the person lives. So if we look at California, for example, and you're a very high income earner that's maxing out at 37% at the federal level, you're also paying up to 13.3% in state tax on top of that, in addition to 6.2% Social Security tax and 1.45% in Medicare. And that's the good news if you're employed, because your employer is actually splitting that Social Security and Medicare with you. So for someone who is self-employed, it gets even uglier because they're having to pay the full amount, over 15% for Social Security and for Medicare. So how does that break down and add up? Well, if you're a very high income earner living in California in 2023, you would be around 57.95% in taxes. More than half of your take-home wages go to taxes. And if you're self-employed, 65.6% in taxes. So that's pretty nasty. That's a pretty ugly picture, but that doesn't even factor in that some cities have an additional city income tax on top of the state tax. So Manhattan or New York City would be an example of this. They have roughly a 3% income tax if you're working or living in the city. And we're not even gonna dive into other local taxes and gasoline taxes and property taxes and sales taxes. There's a lot of tax to consider out there in the United States. But the good news is if you become a passive income investor, you get the choice to choose what investments you invest in, and many of them can be tax advantage or tax favored. Again, disclaimer, not a CPA, not a tax advisor, not giving anybody advice, but I just want to point a few things out from a high level. If we take real estate, for example, there's something in the tax code that's called depreciation, and the IRS basically lets you deduct or write off a portion of your investment every year over about 27.5 years for residential real estate. So, long story short, in some cases, your real estate cash flow could be 0% tax, at least for a period of time. If you hold the real estate longer than 1 year, you would be in long-term capital gains, assuming that you bought low and sold high and held longer than 1 year. You'd be around 15 to 20% in tax, depending on your total income. These are all things to look into, get your advisors together, and help decide what investments might make sense in your particular case. So again, not tax advice for anybody, but I'll tell you one thing, I'd certainly rather pay 0 to 20% in tax than 60% plus in tax. And you know, this really starts to add up and matter a lot the higher income you go up. Obviously, you're laddering in terms of the federal brackets up to 37%, that matters. But imagine somebody making $60,000 per year and that's their only source of income. They may not be too concerned if they're in a 10% tax bracket or a 20% tax bracket. It's only gonna matter a few $1,000s each year. So it may not be a big enough thing, but imagine now someone making $1 million per year living out in California or New York or you name it, and they're paying 60% of that income in tax. That's $600,000 every single year that they don't get to retain and keep. So just imagine what you or someone else could do every single year with $600,000. So it really starts to matter a lot. So bringing this concept home, I want to leave you with 3 items to consider. Number 1, becoming a passive income investor gives you a secondary way to get a pay increase every year without having to just rely on an employer. Number 2, depending on the tax structure of the investment you choose, it can be much more tax favorable. So imagine if you're paying 50% in overall tax and your employer gives you a 4% pay raise, that's really only a 2% pay raise when you factor the taxes in. But if you got 6% from an investment in 1 year and you had to pay 20% in tax, you're still netting more than a 4% annualized return. And number 3, over time, if compounded, your investments can actually make a livable income that you can choose to live on or to retire with or to just supplement other income in your life. And in fact, I want to share this with you visually. I'm going to put it up on the screen for you in this example. So going back to the investor who makes $60,000 per year, makes one investment in their lifetime of $60,000, makes 8% annualized returns. If we run a calculator here and we times it by 40 years, assuming that's going to be an entire career path that somebody works, then they're left with around $1.5 million as an investable portfolio. Now, obviously, we're not factoring in inflation. We're not factoring in taxes. I'm just using this for an example. But if you take $1.5 million times 8% a year, at that point, if they're still investing all of it, that's $120,000 per year in passive income that he or she doesn't have to work for. That is double the starting salary where they had to work actively for their income. Now, just imagine if this particular investor had made multiple investments throughout their journey and not just one, and what that would look like. I encourage you to play around with some of these calculators you can find online, and these compound interest calculators if you're kind of a bit of a numbers guy like I am. But in any case, I hope you found some value in this episode here on the Passive Income Lifestyle Series. I'm Travis Watts. Reach out anytime if you have questions about passive income investing, multifamily investing, or what we do here at Ashcroft Capital. Happy to hop on a quick call with you or anyone in your network that you think could find value in this content or these episodes. Again, Travis@ashcroftcapital.com. Thanks so much for tuning in. Have a great week, and we'll see you in the next episode.